Good afternoon, everybody. Thanks for joining the Viola FinTech virtual meetup. The first time we are holding that virtually. We have an amazing panelists here from global FinTech venture funds all over the world, which I let them introduce themselves. We have Patricia from Oak, Mellisa from Arbor, Hans from Nyca, and Yusuf from QED. And we are honored to have them as participants in this panel. I guess that we all are living in what we call a new norm. COVID-19 has caught all of us, I believe, quite in surprise, and the world has changed dramatically in the last few months. I believe some of the changes are very fundamental. They have social, economic, and even political impacts that will definitely impact the way consumers as well as financial institutions are going to behave going forward. And I would like today to have our panel share their thoughts about the impact of the COVID-19 on the FinTech world going forward. And without further ado, I would like each one of you to please introduce yourself, your fund, your areas of investment, and maybe relate for the Israeli audience to some of your Israeli investments. So Patricia, please.
Absolutely, and thank you, Avi. Good morning, everybody, or it's good morning here on the East Coast. Patricia Kemp, one of the managing partners and co-founders of Oak HCFT. So we were founded 5 years ago. We've raised 1.9 billion. We're investing out of our latest fund of 800 million, and we do healthcare and fintech. We have approximately 20 fintech investments at this point. All are largely B2B. So most of them are B2B or B2B2C. So infrastructure plays and asset management, payments, lending, insurtech, et cetera. And we have 6, so 6 out of our 20 are headquartered out of Israel. As you all well know, great Israeli software legacy and infrastructure legacy. Very quickly, the 6, Cryon, an RPA space, Pagaya, an AI-driven asset manager, Mogu, software solution protects the customer journey in e-commerce, Authentics, identity verification, Panarrays, automated third-party vendor certification, and then Rapid, which is payment infrastructure provider. We typically are growth stage investors, although we invest early upon occasion. I'll pass to Mellisa.
Great, thank you very much. It is virtual. I'm virtually in Singapore today. So hope to be back sometime in the fall. But I'm Nyca C.Guzy. I run Arbor Ventures. We're a global fintech fund. All we do is financial services, and very much like Oak, we're B2B or B2B2C. About 90% of the portfolio falls in that category. We have 28 companies globally. 1/3 is in Israel, 1/3 is in Asia, spread across Asia, and then 1/3 is in the US. So about 8 of the 28 companies are in Israel, which include Forder, Fundbox, Ever Compliant, Plankry, HiBob, Skyline, Voom, and then of course True Accord is run by Ohad, who is Israeli. So we have 8 of the 28 companies based in Israel. And thank you very much to Avi for hosting this. We're very happy to be here. And I'm sitting on the East Coast at the moment, very much like Trisha is.
Hans.
Hi everyone, I'm Hans Morris, and I am right now in Western Massachusetts, where it has been snowing quite frequently in the last couple of weeks. So that's what it's like here in New England. We are a fintech fund only, and we're on our 3rd fund, and we've invested in about 65 companies. And we typically invest early stage. So seed is about a quarter of the companies are seed stage, and then we also do Series A and Series B. Occasionally we'll do a later stage investment. We also have a real, affinity for Israeli companies, and we've been lucky enough to invest with many of the people on this panel, including Avi and Tricia and Yusuf and Avi. We have 4 companies which are headquartered or began in Israel. So Personetics, Ever Compliant, Payoneer, and Skyline AI. And then we actually have 4 other companies which have Israeli CEOs, which are True Accord, ZenDrive, Fundbox, and Peach. We do consumer-facing companies, but the majority, I'd say we're probably 65%, 2/3 are enterprise, and also a lot of infrastructure, digital advice are important themes. And anyway, we'll talk more about that once we get started on other questions.
Thank you, Hans. Yusuf, please.
Great, thanks. Yusuf Ozdalga, anchoring QED's UK and European efforts, which includes technically Israel as well. QED was founded in 2008. We focus predominantly on FinTech, have done some stuff in PropTech too. We were founded by Nigel Morris, who was the co-founder of Capital One. So we've had a pretty strong focus on payments, banking, credits, mostly in these areas, but we looked at other things as well. We've done some in InsurTech, very little, and a few other things. 2/3 of our investments are typically in the US. 1/3 is international. And from that 1/3, the lion's share has probably been in LATAM, where we've done investments like Nubank and Creditas and Confio. So Europe as a whole has probably been 10%, and that's been pretty heavily anchored in the UK, where we've done things like ClearScore and WageStream and Fidel API. We have done some outside, so we've done Klarna in Sweden, and I happen to be half Swedish as well, even though that was not my investment. And we certainly would like to do more in Israel. We have strong ties to Israel. We have various companies that we have. None are actually headquartered there, but we'd love to certainly change that, hoping so, and working closely with Abi, and we've been building a closer relationship, which we're excited about, and with everybody else, obviously, on the panel as well. We've had co-investments, which we're very happy to share.
Okay, thank you all. Definitely an A team of investors that have a global perspective as well as a very strong Israeli perspective. So, we all have very large FinTech portfolios. So let's start with our existing portfolio. And some of you are only B2B, some of you are across B2B, B2SMB, and direct to consumers. So what have you guided your portfolio companies that were caught, as all of us, in the midst of this phenomena? And are there any sector-specific guidance like payments, insurance, SMBs, or B2Bs? So maybe we'll start in the order we introduced ourselves. Tricia, please.
Yeah, absolutely, Avi. So, every company is different, and you have to look at the specific situation. But with every company, first of all, they've acted defensively, and then some of them have been in a position to act offensively. So defensively, everyone has created scenarios of different cash inflows, different revenue tractions, if things go one way versus another, if AR comes in slower than was expected, even though there are due payments. So every single company has assessed their capital spending, assessed their expenses, have cut non-essential expenses, have managed sort of what the cash flow is given potential different scenarios. In part of that, of course, you then look at your marketing expenses and your cost per acquiring a new customer and how you market and how you sell, such that you can maintain a certain sales projection. Many have been able to act offensively because they've got a great cash position, so that they've been able to do a tuck-in acquisition. They've been able to create a product pivot that has worked well and has found more buyers in this particular market. They've been able to serve the issues. So every single company, it's sort of capital spending, managed defensively, any non-essential expense that's gotten rid of, and then scenarios on when revenue might come in, how they do go to market, how sales might adjust, marketing might adjust, and then how to act offensively.
Thank you, Ali.
Sorry about that. Yeah, to Trisha's point, I think every company is doing it. I think what makes our portfolio unique is we started dealing with this on January 23rd when the first COVID-19 cases were identified and well known through Asia. And so it was quite interesting because we started to get a handle on the portfolio then, understanding, what happened during SARS. And what was fascinating is I came over to the US during Chinese New Year and the reaction was, yeah, but that's an Asia issue. And I remember very clearly having discussions with our US portfolio saying, it may be an Asia issue, but when the second largest economy is on lockdown in the world, it's everyone's issue. And so I think we were able to get a hold, working through with the portfolio companies on spending and budgets quite early on. I think one of the greatest challenges now, not to repeat exactly what Trisha said, because I think every company and everyone is doing that with their portfolio. So just to add to that, I think the greatest challenge is going to be enterprise sales, the wine and dine. Is that gone? And how are you going to do enterprise sales? And is it going to look like, have to look like plug and play? I also think just global sales are going to be challenged for a period of time. I know life is getting back to normal in Israel and maybe Connecticut, but Asia is going to take a very, very strict view of travel and blood test and cross-border. And I think that is something we are thinking and spending a lot of time with our portfolio companies about is, okay, we got a handle, we have scenarios, we have planning. Some can be offensive because their businesses are doing better. Some need to be more defensive. But what does the world look like post-COVID? And trying to plan and think about that is something we're spending a lot of time on with the portfolio companies right now.
Thank you. Hans, please.
Well, we're all agreeing that it matters a lot depending on what the company does, and that includes where they stand in their fundraising. So if you've just raised money, you feel pretty good. If you have to raise money, it's a lot more anxious, I'd say, because the investors are clearly being more skeptical, and I think for good reason, being a lot more skeptical of projections and ability to get how much capital does it take to get to cash flow break even. That's really the most important question right now, whereas a year or two ago, that wasn't a particularly important question. You could assume that a good company would be able to raise money to finance operating losses. That's not true. Another big difference is, do you warehouse risk, or how much risk do you warehouse? So if you're lending or underwriting insurance or taking other risks, you need capital. And if you need capital to support those risks, what's your return on that capital? And what's your capital generation rate? And what type of business models that really look like? That's a very important issue right now. And if you are a marketplace lender, there really is no liquidity in that sector. So it's almost impossible to fund right now. And will that change? No one knows when that's going to change. I think the last thing I'd say is I agree with Mellisa. Many of us we do enterprise companies that pursue enterprise relationships. One piece of advice I have for our companies is you have to have a product that delivers an immediate ROI to your client, and that needs to be something that can be analyzed and installed in weeks or days, not months or years. So those products, if you're solving, and there's lots of immediate problems right now that are very, very important, like digital collections, for example. But if you can do something like that, I think you may find an acceleration in your enterprise sales. But if it's a long analysis and involves a rip out of a system, I think that's almost impossible to sell right now.
Thank you. Yusuf, please.
Yeah, I totally agree with all of this. Just to add some extra points, one theme that's emerged more so in the last few weeks, I would say, around people is that twofold, actually. One is that this work from home in some shape or form may last a bit longer than most people initially thought. It's not like we're going to wake up one day and somebody's going to have a vaccine ready, in 2 days, and we all go back to exactly how it was. And combined with that first point is this realization that not all employees in all of our portfolio companies are dealing equally well with working from home. People have different work circumstances, so likewise they have different home circumstances. And I think some employees are finding it more stressful to work from home. Some people are finding this whole situation more stressful versus others. So we've been spending some time in the last week with our CEOs to talk to them about how should we, sort of adapt the cultures? How should we adapt our processes? What can you do as a CEO to better enable your team culture to thrive in this environment? And we've seen a lot of companies taking very interesting kinds of action here. It could be team building. It could be how they're hiring. So we're trying to sort of collate this set of best practices for work from home for our CEOs. So that's one thing in addition to everything else we talked about here that we've been focused on.
Okay, that's great. Maybe I will share some of our experiences. We have companies both at early stage as well as later stage. As I said, everything from B2B to B2SMBs to direct to consumers. I believe all of them have been impacted by the new norm and by the new situation. So nobody is excluding from that. And we have worked with all of them to really address what we call the new norm. I believe that there are still a lot of unknown going forward. People, definitely on the B2B, people have not yet figured out what does it take to do remote B2B sales. And definitely if you have something that is absolutely needed by the enterprises, a financial institution, be it insurance company, be it a financial bank or a credit card company, then you'll get priorities. But only as we speak, people are actually figuring their budget, and CFOs are taking over business units, and the CEOs are taking over CFOs and are telling them to cut budgets. So it's not just new opportunities. I guess that we'll see, and I believe in one case we already seen, people are notifying their supplier that they are not going to renew a contract, which can be significant, which means, by the way, what is the real value to that specific customer from that business. On the other side, I believe talking to CEOs of financial institutions, I have done that quite extensively over the last few weeks. Definitely there are three priorities. First of all, the world is getting much faster to digital world. We all understand it. Helping people to work digitally, to work remotely. Second one is an increased emphasis of cost of operations. So everything that can help them reduce their operational cost by increasing their service level is very important. And thirdly is actually being more automated in the way you drive in your customers, in the way you help them drive their own financial services, their own financial health, both at the consumer, SMB, and even big enterprises. I can give an example of a joint investment with Nyca and Personetics. It's an AI-driven retail and SMB banking solution for medium to large banks. And actually they found a lot of opportunities in helping their banks, helping their consumers and their SMBs to better manage their cash flow, to better use alternative sources to go over issues that appeared overnight. And so they get a lot of traction from mainly existing customers. We all know existing customers for our portfolio companies are the most important asset for us. And we have advised all of our companies to double down on nurturing their relationship with their existing customers and try to find opportunities where trust is also already there. By the way, it's also relevant to direct-to-consumer companies. So definitely there are a lot of things to be adjusted. I believe that still there is a lot of unknown going forward, and we'll have to figure it out on the fly, on the road when things are changing. But one thing, at least on our mind, is that the world is not going to be the same, even if they will find solutions to the problem. I believe it's a very fundamental change to the behavior of the whole ecosystem. So this guides me to our next question. Okay, what about new investments? Are you guys looking at new investments? Have you changed your criteria? Are there any interesting areas that you believe are more interesting than other areas? So what are, we have an audience of entrepreneurs. By the way, we have crossed over 150 attendees. So, and it's picking up. So they would like to hear from us. Okay. What are we doing with new investments? Have we changed our criteria? Are we actively looking to invest in new companies? At which stages? So maybe you can share your views on that. Patricia, would you start, please?
Sure. So there different parts of that. One is kind of what industries or what's the business solution, and it's very related to what you just went through, Avi. Companies that are providing absolutely needed ROI tested infrastructure, whether it's data, whether it's analytics, whether it's a outsourced processing platform that allow financial institutions to more efficiently digitally provide what they're trying to provide. You could also say the move towards digital means e-commerce solutions, everything in and around e-commerce, security, fraud, payment, gateways, et cetera, all are areas that are going to see continued growth as just two examples. And then you turn to what we've just been discussing of each company. What's the go-to-market strategy? How hard a sale is it? Is it enterprise sale that you can do remotely or with a hybrid model? Is it something that shows a fast ROI? Everything that we've kind of just outlined, you want to see in investments you're looking at going forward, such that you can see a trajectory that might occur over a different timeline.
And have you done any new investments in the last 2.5 months?
Have we done new investments the last 2.5 months? We have done follow-ons. We've done new investments in the healthcare space and healthcare payments space, but we have not done in strict FinTech. We're about to, but not yet.
Okay, thank you. Mellisa, please.
Yeah, I think we've now spent the last couple of weeks looking at new investments, and we will continue to do so. I think we're done triaging the portfolio and feel pretty good where it is. I think for us, new sectors, as Trista said, we've always liked anti-fraud, that area. So we continue, we've done 4 investments in that space. But one area that we think is we believe that COVID-19 is a new license for governments to put in digital regulation that they were tiptoeing around in the past. And we saw it, GDPR expanded outside of Europe, really expanded to Asia. And now we think that this is just going to be a free license for governments to go ahead and implement that digital regulation that they've been talking about and tiptoeing around. We're going to spend a lot of time around that, because you can't be Visa and transact globally if you have to deal with local regulation around data privacy and information. So we're going to spend more and more time thinking, again, around the infrastructure like we have been, but thinking about where the new problems are and how to solve some of those new problems. So I would say digital regulation, anything around e-commerce and enablers, also, anti-fraud. I think for us, it's really a question of geography. We'll continue to look at Israel. I'm far more positive that Asia is going to come out of this economically stronger than maybe other parts of the world, depending upon what the trajectories look like. We took the pain pretty hard on lockdowns, but the flip side of it is I think there's a systematic approach to getting back. And if you look at where the factory levels are and you look where some of the numbers are, Asia clearly is starting to rebound, and we're thinking about, geographical distribution for the remainder of this fund. So
thank you. Yusuf, have you reconsidered your investment area, stages, geographies?
Yeah, for us, so we had a number of term sheets outstanding, which we all ended up investing in. And we also did, like everybody else, a very deep and intense focus on our existing portfolio. And we've also done new deals since COVID-19. So I think we're on schedule to deploy as we were planning. Having said that, obviously, the world has changed a lot. So our approach is that, the bar is always high, but it's, even higher than high now to some extent. But that doesn't mean that we're not investing. We're actually investing a lot. But I do think that we see some on the macro, some pullback macro for the whole industry, which means there's probably, when you look at the supply demand of investment balance, a higher threshold, not just for QED, but for all funds, just because of this dynamic that's happened naturally. And that means for any founder that they have to face up to that. And also what I see is a bit of a bifurcation in the market where if you're a very good company doing really well, demand for that is as high as ever, if not higher, because people still want to deploy their capital and invest. But if you're not on a solid trajectory, I think investors are a bit less forgiving in this circumstance. So unit economics, focus on profitability, ROI, all these things that we historically have been very focused on as QED have come even more to the forefront now, we feel like. And in terms of sector focus shift, that happens naturally anyway. So we definitely look at, or if I can speak for myself personally as well, look at financial data aggregators a lot more, and that was a trend that was continuing. I think COVID only accelerated that trend as it has many other trends. So I think within our sector focus, I would just say that existing trends we looked at just really accelerated. And I don't think there's whole new trends that we look at that we weren't at before. One thing we've seen, and we maybe talk about it a bit later in terms of who's advantaged and not, is a little bit of these more older school lending models, I think are under a lot of stress. So we can talk about that later. So yeah, seeing a lot, but we definitely live in a dynamic industry, and this has made it even more dynamic.
Thank you. Hans, please.
Okay, so some similarities to what everyone has already mentioned. I think that a couple of new areas, well, actually, let me go back and say, yes, we have made some investments. We have one pending, and we've also made one small investment since March. And so the themes that were, some of the themes that have always been important, which Mellisa and Patricia and Yusuf have all talked about, remain important. So, you know, fraud, risk, all that, it evolves, and the nature of it and the specific problems tend to change. We focus on this concept of payment optimization. So optimizing a payment and your decisions for risk, cost, and timing, and that will become much more relevant with real-time systems now becoming more ubiquitous around the world. And that optimization function is something that's actually quite hard to do and not done. And since there's so many small businesses and consumers who are in stress, your ability to make intelligent decisions about that is a very important capability. So that's one key thing. One area that we do a lot in is capital markets related technology, and the company that we're investing in it does collateral optimization, which to many people doesn't mean anything, but collateral is essentially the blood supply for the securities industry, and optimizing collateral has very significant impact on the efficiency of a business, as well as the risk profile of a business. I think that healthcare, I think one thing that's interesting that Tricia mentioned, healthcare payments is really complicated. But one thing you could say is that people are coming through this crisis in the United States with a very different set of expectations and some bad experiences that they've had with the healthcare payment system. And so people that can make that, companies that can make that seamless and effective, we think is this could be one of those catalyst shifts where behavior really does change. And then another topic that we're thinking about quite a bit is education value added, given the unemployment and all this uncertainty about education process in the United States, but everywhere. What are different models for financing that in a way that also assures that there's value that was created in the process of providing that education?
So we fully subscribe to this cross-section between the healthcare system and the financial services system. From funding, the cost of the healthcare system up to payments, things like that. We actually have done an early stage seed investment in that space before COVID. And as Viola, we have done one seed investment, actually late March. We are looking to closing another seed investment and another A round stage investment. And our global FinTech fund is actively closing 2 deals which are a little bit later stage. So we are active. We are definitely more selective. And definitely the bar is getting higher, but also there are opportunities for good companies that if there are people that are more hesitant to join this club, you have to act fast and maybe get access to companies that before you couldn't have access to. So there are opportunities there, but definitely you have to be very careful to look at the fundamental and to estimate what are going to be the headwinds and the tailwinds. And I'm not sure we all know what's going to be out there. For the growth stage investment, we have also looked at growth stage investment for a path to profitability. Is that now a much more strict area, Patricia?
The path to profitability? Yeah, I would say yes. And of course, that's, current portfolio companies plus future investments. You want to make sure the unit economics work. You want to make sure that the sales process is going to have the same payoff that it had in the past, and there are unknowns to this. The greater certainty around all those metrics, I think we will, help an entrepreneur raising money, particularly because of the uncertainty in and around this. How is it going to be marketed? Are there distribution partners that could get you there? All of that are part of the fundamentals that I think are, even more critical as we look at new investments.
Okay, thank you. So maybe we'll address some of the areas that were mentioned. So, we have seen a lot of investment in neobank and digital banks, to a certain extent, over-investing in that space. And what you guys think about the space and the opportunities there? We are seeing people that are out of funding and getting out of the market in the last few months, even before COVID. So please share your views. Maybe Hans, you start with your views on the challenger bank and neobanks.
Well, I've been thinking about this a lot. One issue we've already talked about in a couple different manifestations, which is, how much capital does it take to be a bank, a challenger bank or not, and then what, and so therefore, and there's different answers to that question depending on the way they deliver. So Chime, for example, delivers as a prepaid model, so they're not holding the assets, their bank partner does. Others are full stack regulated or want to be a full stack regulated entity, so they will have capital requirements. The other thing is profitability of a bank typically depends on having both sides of the balance sheet. That you need to have a deposit, low cost deposits, and safe, high yielding assets, and then very, very low cost of operations. So what's intriguing about many of these neobank models is their ability to have very low costs, and also to have to have very clever and effective ways of getting customers, and in many cases at low cost. But still, the economics to us many of them are not that attractive because of this capital requirement and their inability to, at this point, to date, have an attractive asset strategy to go along with the liability gathering. But that might change. I also think what's different about this crisis, and I think this is a real important question, at least in the United States, is the banks so far are having a pretty good crisis. Last time there's a huge opening created to fintechs because we were at the beginning of a massive re-regulation cycle globally, and that had required lots of, all their expense focus had to be on meeting the requirements that they were subject to, and also they were very much blamed for the crisis, and so it created opportunities for new companies to come in and say we're not a bank, and it's easy to criticize the bank practices. So far, banks have been quite forgiving on fees. They've been helping out customers. They've actually, I think, done well in managing the public relations aspects of this. And just in the first quarter, JP Morgan grew deposits $200 billion. So, when you talk about how successful some of these neobanks are, just put that fact in context. So I think that we have invested in some neobank models, but I think the right answer to your question is you should be careful and deliberate, and there's a lot that's still uncertain.
Okay, thank you. SMB has been hurt dramatically in this crisis. People, stopped spending. People couldn't get out of their homes, and definitely there are very large companies that have been hit. But the SMB in general all over the world have been hit very dramatically in this space. And we have seen SMB as a growing interest from all stakeholders, both from the incumbent financial institution as well as from companies addressing the needs of the SMBs. And we are now seeing on deck being sold for a penny and others being challenged. So, but still there is an issue there. These guys need to be serviced. So what's your view on that? Maybe we'll start with Mellisa.
Yeah, I think it's obviously a market that's been hit very hard across the world, but I think it comes down to the CEO and leadership. As certain types of SMBs go away, other types are formed. And I'll give you two examples. I mean, two companies in the SMB space we have. We'll start with Viola in Indonesia. The SMB market in Indonesia, has had a double whammy, not only COVID-19, but also hitting during Ramadan. And, business really, really dropped off very, very dramatically. The CEO was quite clever. He decided to switch the business and become, sorry, it's a fire alarm, to become a distributor of masks and sanitizer and be government regulated. And so I think, here he was extremely creative to say, okay, my existing SMB business is definitely going to be hurt during Ramadan in this period, but what else can I do? And what other types of industries are coming up? And so he's basically now in healthcare distribution. I think also in the US, we've seen it. But as I said, as more, as maybe some businesses like construction and travel agents and bars and restaurants have been hurt, there's a lot of new businesses that have actually started to go online. And so I think small, medium businesses moving online is actually a massive trend. And I think there'll just be a shift, and the more creative the CEO is to look for the types of businesses that are, SMBs moving online and be able to service them from whether it's a payments or an enabling technology. I think they'll come out of this and do quite well. So you got to be creative, you can't stand still. And I think there are certain businesses, obviously very hurt, but others, new ones coming up all the time.
Any other participant, Yusuf, Tricia, to comment on the SMB space?
Yeah, I mean, SMB space definitely has been hit pretty badly. I think if you are a sort of monoline lender in the SME space, wholesale funded, and you just have the lending product, I think that one has been hit particularly bad. We grew we saw the growth of Capital One. Nigel was a sort of co-founder, and we've all been involved. Capital One was a monoline lender in the 90s, and it had its challenges, and a lot of the competitors of Capital One do not exist today. You know how hard it is to be a monoline lender. And in the SME space, as a vertically only SME focused monoline lender in today's environment, it probably doesn't get much harder. Having said that, the SME space is huge. It's the lifeblood of the economy. And I think there's going to be a lot of interesting plays that we're looking at now. Some of those are in the infrastructure, like data aggregation infrastructure space. Some of those are in the SME process automation space. So those two areas in the SME space, I'm very bullish on. And continue to actively look for investments in those two areas. Monoline lender, obviously we have plenty in our portfolio and we know the model well. More challenged, but you can do things to remedy that. You can start adding more products, deep relationship, going into payments. So there's a lot of different case-specific things that can be done in those instances as well.
So, just to add to what Yusuf is saying, providers of solutions that help legacy players service the SMB market, whether it's a traditional lender that is trying to manage it, and of course, a lot of this got automated during the PPP process, whether it's an insurance carrier trying to service this market, you're seeing many more interesting solutions that are focused on helping traditional large legacy players manage the SMB market. And of course, there are big differences between the long tail, the S, and the ongoing M in that. But it will become more automated over time. And again, as Yusuf said, there are providers out there that have seen an uptick in volume, a couple of our companies, because they're helping automate that process.
But this leads me to a next question, which is actually the balance between the incumbent financial services institution across all sectors and the disruptors and the emerging fintech companies. We saw, I believe, a decade ago, disruptors are trying to replace. I believe in the last couple of years, we have seen a lot what we call the fintegration, where people realize that there is a room to actually team up, either due to balance sheet needs or to distribution needs. Is this balance of power going to change? And what are the opportunities in possible changes in this balance of power? Hans, maybe we start with you.
Well, I think it depends. There's some really good banks that I think have completely changed the way they're thinking about technology. They are creating very good technology. They're incorporating third parties effectively, and that's not just big banks. I met a very impressive bank CEO of a small bank in Florida that's got single database, really smart, good digital products, very open-minded about further adoption. So I think that my message is, if you're a fintech, you in all likelihood are going to need, you're definitely going to need to integrate into the financial system, and in many ways partner with other institutions to deliver products. Even if you're direct to consumer, you're going to need to do that. And there are some fintech companies that are becoming real enterprise, trusted enterprise vendors, and it's very real, very significant. And I'd say, so that's a reality. And I'd also say there are many banks, which is if you're not very focused on technology and better experiences for your business customers and consumers, you're not going to meet their expectations, and their expectations continue to rise, and you'll find that your best customers are leaving you. So both fintechs and banks are going to need to adapt, and I think some will make it and some won't.
Mellisa?
Hopefully the fire alarm is over with, but sorry for that. But I don't see it changing very much from where it has been. I mean, I think there's certain, we actually don't have a lot of companies necessarily that sell to banks. And I think they've been, when we look at those companies that do sell to banks, they've been quite challenging. I think we prefer companies that sell to non-bank financial institutions because they seem to be much more willing to partner and to adopt technology. I think going forward, it'll be the same. I think it'll vary around the world. I think the Middle East is a very good example where the banks are starting to partner now with fintech startups and making some progress. I think Singapore, it's been less so. I think it's been frustrating for MAS to do it. Hong Kong clearly has been pushing it forward. So I think it depends where you are in the world of how the scenario is going to play out going forward post-COVID-19. I also think the banks, sorry, I'll let somebody else answer. I have no idea why my fire alarm keeps going off. I can assure you there's no fire though. So go ahead, maybe Tricia picks it up. Sorry, I got it.
Well, I don't know the exact sentence you're on, Mellisa, but so I think that this has been a 10-year trend that's now been kind of accelerated by this crisis. So, 15 years ago, a large bank, a large insurance carrier, a large asset manager would not sign a contract with a smaller fintech vendor. And of course, 15 years ago, I'm not sure the word fintech even existed. What you've had happen over the period is a lot of those large legacy players have realized, well, gee whiz, the smaller provider with the 50 engineers, whether it's Midtown Manhattan or Tel Aviv or wherever it is, are creating a better solution. And if it's not a heavy lift, tack it on. They have moved towards doing so. And I think that you're going to have a large push, obviously, over the last 8 to 10 weeks in what they would call digital innovation, right? As they try to move more and more services to digital, again, whether it's an insurance carrier, an asset manager, or a bank, I mean, we all know the phone rooms couldn't take the volume. There needed to be alternate ways to do this, the way to communicate when you couldn't get into a local bank branch. All of that has accelerated, but I think it was all moving that direction, and this just caused it to tick up. The downsides of that, as Melissa pointed out, is you have longer enterprise sales cycles. You need to make it an easy lift for the bank, as Hans, I think, pointed out earlier, versus a complicated on-premise integration. So selling to a bank and getting it implemented in production is a lot harder than being under your own control or selling to a smaller FinTech or a new player. But then once you have it, I think you're actually in a better position in the long run, or you have the contract. It varies geographically, it varies by industry, it varies by size of the institution. But I think that you're just having an acceleration of a trend that has been happening over the last decade.
Thank you.
Yeah, just to add to that, one interesting thing that seems to be coming out of this is that just like all sort of digital transformation is accelerating with this crisis, that's especially applying to banks, traditional banks and their customers. And in a very interesting way, that seems to be effectively helping the bigger legacy banks compete better with some of the FinTech startups. They're becoming more digital, branches are closed, they're now being forced to deliver their products digitally. There's a lot of statistics that are being shared now that shows that this is indeed happening. So that creates this interesting thing where the crisis, relatively speaking, seems to have helped, legacy banks versus FinTechs a little bit, yet there may not be as many factors that have helped FinTechs, except of course that the macro digitalization is increasing, which helps FinTechs, but it seems to have helped banks a bit more. So that's interesting. And I think one of the implications of that for FinTechs is they have to lean in even more heavily into their core areas of strength, be even faster, innovate even more, and stay even more relevant. And know that just because the world is digitizing faster doesn't mean that that's going to be an unmitigated good for them. It may actually help banks a lot in this process. So I thought that was pretty interesting. And overall, of course, when you step back from a higher perspective, I do think that this increase in digitization is going to help a lot the sort of tech landscape. But I think both within legacy banks and within FinTechs, as I alluded to earlier, there's going to be this bifurcation. So for banks, like Hans mentioned, whether they be big or small, the ones that can invest in technology well and has been investing in technology will really benefit. And the other ones will be really left behind. And I think the ones in the FinTech space, the ones that are getting to scale, customer scale, capital scale fast, will benefit, whereas others will not. And the last thing I'll add is geography matters now. When you look at challenger banks, for example, I mean, we have Nubank in Brazil, very different landscape from UK, again, very different from US, very different from Israel, and each geography is different. So those differences will probably come to the forefront even more.
Does it mean that direct-to-consumer FinTech companies will have to leverage the marketing and the trust that medium to large bank or insurance companies or whatever have gained with their consumer base and actually replace some of the direct-to-consumer channels with what we call B2B2C?
Well, we've seen that already in Asia, right? You saw that Gojek partnered with UOB and now has partnered with Singtel. I mean, Grab did actually partnered with Singtel and UOB. Gojek is with DBS. I think we've seen those partnerships clearly across the region of what I would call aggregators of consumers who want to offer financial services, who have then connected with the banks for multiple reasons, whether it's regulatory or just the trust factor for consumers. And so I think that's a trend we're going to continue to see more of, at least in Asia.
Any other comments on that?
Yeah, I mean, I think it's interesting. I think if you even think about lending and, B2C lending and this monoline lending, as we were just discussing, I think finding an innovative twist on that and either combining that with the payments or combining it with some other element will be important. And that definitely could be a B2B2C kind of distribution of the lending product itself, as it would be for any product. So I think those will be interesting areas to watch. Totally agree.
Thank you. So, in a distributed world, with increased fraud and people working remotely and businesses remotely, is there an increased interest in blockchain as an infrastructure? I'm not talking about cryptocurrency. So maybe Hans?
I think it comes down to whether it actually is superior for some sort of process. And I'd say that I think all companies have learned a lot about this. And there are some examples where I think it is effective. And I'd say in the enterprise world, it primarily relates to applications where having synchronous data is an essential characteristic, where reconciliation of data is expensive and difficult, where speed is not necessarily that important, and where there's not a tremendous cost of change. So if to replace some existing system, it sounds great, you could do it from the beginning, but getting that whole ecosystem to change is really hard. So you have to start with something that's narrow enough and small enough so that that having synchronous data is a very compelling competitive advantage, and you could start out bilaterally. That would be some of the criteria that we apply to where it can work and where it doesn't. I also feel that a lot of that DLT is fading to the background. It's just another way of organizing a database, and maybe it's better, maybe it isn't. So I don't think we don't go out looking for things that are using that technology.
Any other comments on that, Mellisa, Patricia?
I agree. I mean, it's just a new database structure that's part of the innovation trend, but we don't look for companies that are necessarily DLT or saying we're doing the blockchain. I mean, I think everyone would agree a couple of years ago was blockchain everything. I don't think that's the case, and we don't look at it specifically. I mean, we're seeing use cases, but I mean, somebody has to have a really, really good reason why they're telling me they're using DLT for something. I completely agree with Hans on that point.
Okay, thank you. So I would now ask each one of you to maybe make a couple of closing remarks to the benefit of the audience here. And we have, exciting audience from all over the world. And what will be your advice that maybe you can relate also to the offensive move and maybe to the possibilities of actually consolidation of players to become even bigger? Patricia?
Absolutely. So first of all, to the entrepreneurs out there, we all have capital we have to put to work. So everybody is looking for investments. And again, a little bit what was said earlier, there was 4 to 6 weeks spent triaging our current portfolios, but opportunities are coming out of this, right? And opportunities are being accelerated. And what everybody is looking for, and it sounds repetitive, but a solution that benefits from the further digitization of all the legacy players. And that has a go-to-market strategy, right, where they're maybe not dependent on going directly themselves, where they leverage some sort of distribution partnership, and where the economics, the unit economics, such that they get to profitability, are believable, incredible. And I think that everybody here sort of believes that there's an acceleration in many of the trends within, the financial services ecosystem. And so players that are servicing those trends and have, a proprietary solution or a tech solution that is well positioned in those trends, I think everybody's going to be interested in. And if you're a current entrepreneur with a solution and a company, I think what you've got to pay attention to is a little bit what everybody said defensively earlier, which is figure out your path to profitability. Figure out your path to profitability, pretty quickly, right? And manage your way there. And if you have to pivot, do so. But everybody's a believer in the FinTech ecosystem. The FinTech ecosystem is going to come out of this stronger, and our providers, many of them are providers that are going to help as financial services companies move forward. So there are many opportunities, and I think there are many funds looking to put money to work.
Thank you, Mellisa.
Yeah, I think, well, first of all, any entrepreneur who's building a company has my empathy. I don't think anyone expected a pandemic in their lifetime like this. So I think, our suggestion is going to take grit and perseverance and concentration and just really, I think it is though a time that's quite liberating for a lot of companies, and to look at it that way, where you have the opportunity to maybe, cut expenses, take this time, which can be to think about what is next, and get off the treadmill for a little bit here, and think about how you want to position the company going forward. It's also been a time to deal with underperformers in companies, or rethinking how you want to go about the sales process for enterprise sales. So I think it's working very closely with the portfolio companies and with any entrepreneur to really think about how to position the company, well for the future. Everyone on the call has capital to invest. Everybody is very positive about FinTech. I think, but for an entrepreneur to really position the company for the future, be able to communicate and articulate that, how they're going to reach, it's got to be capital efficient, and it's got to make sense in the new world. We're going to a new normal. What is past is past. But that's what we've encouraged entrepreneurs to do, is really use this period to think long and hard about their business models and what they're doing at the company. And to look at this as somewhat liberating, although extremely challenging time for everyone out there.
Thank you. In the respect of time, we have like 1 minute. So Hans and Yusuf, closing remarks.
I will just quote from the Aeneid. When Aeneid is shipwrecked, he tells his crew lying on the beach, he says, maybe someday you will rejoice to recall even this. So keep that in mind.
Thank you. Yusuf.
Yeah, I mean, being an entrepreneur is not easy, and this unless you're very fortunate, this has not made it easier. So I think my thought would be focus on two things, right? Which is what you do best, your product, your technology, just really, really focus on that. And then two, your people that make it happen, right? So I think focus on your product and delivery, focus on your people, and don't be afraid to ask for help. That would be my advice.
That's great. So I would like, guys, really to thank you a lot for your thoughtful remarks and understanding. We hope to see you face to face as soon as possible. Thanks for taking part in this virtual webinar. And I would like to thank the attendees that have joined us. It's over 150 people from all over the world. I can assure you there are great opportunities here in Israel, and we are looking forward to partner with each one of you and to continue to build great fintech companies that will solve global problems. Thanks a lot.
Thanks, Avi.
Okay.
Thank you.
Thank you.
Everyone.